Hey everyone, it's been a while. So today we're gonna have a look at Intel's earning that just was released let's say an hour ago. And as you can see, it's really looking good. I mean, we are up like 6% of the market. And to be honest, I was kind of expecting it, maybe not this good, but I expected that things would get turned around very soon in the coming few quarters. And let's not celebrate too early, but at least this kind of looks promising. It's not as dire as we could have expected before. But anyways, let's jump straight into the discussions. So here you have the outlook of Q3 that they gave 3 months ago. So at the end of the Q2, they had this outlook of the Q3's numbers, and we can see that the revenue would be, let's say, between 12.9 and just below 14 billion, gross margin at 43%, and EPS at 0.2. Now the interesting part here is that now if we can look at the actual numbers that just got arrived, so they have the number of 14.2, so they actually beat it by quite a bit. The gross margin was supposed to be around 43%, as they said here, you can see, but now we are at almost 46, and the EPS is more than double than the actual expected outlook they gave. And this looks promising because sure, 0.41, how much is it actually? Well, if you think about it, if you analyze it and make it times 4, we get something like 1.6 US dollar. And then if you do a quick Googling search, you can see that Intel has just north of 4 billion shares outstanding. So if you take this 4 billion number of shares outstanding and you multiply it by the amount of earnings that we estimated would be, let's say, 1.5 to 1.6 US dollar for the full year at this run rate. So if we keep the same pace, then we would be around, I guess, it's difficult to say, but let's 6 billion. So yeah, 6 billion in, let's say, earnings after tax. And so again, how do you compare that number to the value of the company on the market? Well, it's quite easy. I mean, look at this. So at 136 billion US dollar of market capitalization right now, and if you divide that number by let's say 6 billion or 7 billion, so after the quick calculation you can see that it's roughly 20 times or 22 times the earnings, so basically a PE ratio of 22 times. Okay, it's not like extremely cheap, but it's not too expensive either, especially if you compare to the competition like Nvidia. And also you have to remember, this is Intel in a really bad shape. I mean, we are still like in a difficult moment for the company. So this is not Intel, let's say, compared to, if we go back to the good quarters of Q1 2022, you can see here that they had a quarterly revenue of 18.4, and now I think we had like something like 14.2. So despite the beat, we are quite a bit off from those numbers of 18.4. And if you actually look at that one that is even better, the one previous to that one, so this is actually the fourth quarter of 2021, and you can see that they were at 19.5 billion quarterly revenue. And especially the interesting number here is, in my opinion, the data center DCG component here at 7.3 billion. And if we are looking at the number now, so we have to scroll down a bit through the report, and we can see here that the data center revenue is to be honest nowhere close to those kind of numbers that we saw at the end of 2021. I mean, 7.3 here, and now we are at like 3.8 billion. Although it's somewhat better than the last quarter, I guess, because we had more revenue last quarter in data center, but with worse margin. So there seems to be at least some kind of regaining of margin on the data center revenue. But again, this is not a good look in terms of data centers. So I wouldn't be too happy, especially on this part, which in my opinion is that part of Intel's market where AMD will be even more stronger in the coming years. And actually we can have a quick look at my this ugly chart here and you can see that in 2023 they launched Sapphire Rapids, whereas AMD are very competitive with their Genoa, Bergamo, and Siena lineup. And the Emerald Rapid is gonna be like some kind of improvement. I mean, sure, there is some kind of architectural improvement on the actual core of the CPU, but still we are going from like 60 cores to 64. So it's not a big improvement in that sense. The big one is actually those coming next year with Sierra Forest and Grand Rapids. But again, we don't know how competitive they will be with AMD's 2024 lineup with the Zen 5 based Turin, Turin Dense, and Turin X. To be honest, I think the situation for Intel might be better than this year, and especially better than 2022 on the server side, so on the data center segment, which is the very important one as we talked about again. So this part here, that's called the data center and AI group. But again, like if we are considering 2024, I think Intel would be more competitive, but I would say that AMD still will be in the lead on the data center, which means that they should be able to grab some more market share. Now, the interesting question here is that will AMD be able to grab this market share at the same pace, or will Intel slow the bleeding, so to say? So is this lineup compared to AMD's good enough to slow the bleeding, which is, in my opinion, where it's actually most important for Intel as a company, because we need to see these like numbers here at Q3. I mean, optimally next year at the same time we would like to see, let's say, 5 billion or even more, especially if you add the AI component to it, and that would obviously increase the margins, and this is where they can make big money. And quickly, let's have a look also at the outlook for the Q4. And if we are scrolling down to the outlook, and so we can see here, so the Q4 they are expecting 14.6 to 15.6 billion revenue. Gross margin is supposed to go up again, and EPS seems to be going up slightly a bit as well, sequentially, and year on year they are saying like they are expecting something like 200% upward compared to last year's Q4. So yeah, in my opinion, this is not a confirmation that Intel's seen the worst of the ride, but there's definitely some good signs in here, and in my opinion, they show that the bleeding kinda starts to slow down or even improve in some sense. But again, this is only one quarter and one data point. We don't know what's gonna happen in the, let's say, next 3 or 4 quarters, and I think we need to be patient and consider at least 2 or 3 more quarters before we are even kind of daring to consider this as a let's say a more safe investment. But again, I saw some good stuff here. I will listen to the call and summarize it in another video later, and see how the things are standing up in terms of their nodes, and how well they are implementing their EUV, so the lithography process, and how well will the Intel nodes, so the manufacturing process, compare to, and how well will they compare to TSMC mainly, especially once we go into 2024, where TSMC will start to have much higher volumes on the 3nm process, which they just launched with the newest iPhones. So yeah, it's gonna be really interesting year 2024. But for the moment, I think this is good enough from Intel. And if we just quickly go back to the earnings report and just have a quick look at some other of the segments. So we looked at the data center mainly because I think that's the important one. Although like right now you could say that the client computing is doing very well. I mean, again, slightly less revenue sequentially, but look at the margins and look at the earnings, like 2.1 billion compared to 1.4 on a base of smaller revenue. So this looks good. Client and computing looks like the bleeding kind of stop, and I think the rumors in the market are that people are starting to purchase more and more computers again. Maybe not, at least nowhere near as in the pandemic time, especially like between 2021 and early 2022. But it's good to see some kind of good numbers here for Intel. And then of course we had the network and edge. Not so good, to be honest. They seem to have quite a lot of revenue here, but they are not making a whole lot of money here. And then we had the, I guess quite a few important segments again, especially the Intel Foundry Services. I mean, it's really good to see the sequential increase in revenue by quite a lot, and also, sorry, not sequential, the year on year by 300%. So this is really looking good, and this is a new kind of service that Intel offers. We could see that, let's say, a couple of years from now, if these services are really going places, then maybe we are actually need to revalue Intel also, not only as a design company. Of course, they are still also a manufacturing company, but I mean in that sense that they are actually outsourcing their manufacturing to the other companies, like let's say even Nvidia or AMD, but most likely it's not meant for them at this moment. It's probably for other companies, but again, if they can really outsource their foundry business, I could definitely see this segment even growing bigger than all the others together. I mean, and why do I say that? Well, look at the TSMC, Taiwan Semiconductor, and their revenue, which is basically only this segment for them. So yeah, really interesting. And then Mobileye, okay, looks good. Nothing surprising here in my opinion. But again, the most important for the going from here forward is obviously the development and improvement of the IFS segment. We need to see really good growth on the data center, and then client computing needs to kind of hold these kind of levels. So yeah, and I'll have a look at the call very soon, and I'll talk to you in the next video. Thank you.